market that is India. I would like to invite upon the stage Dhruv Agarwal. Dhruv is promoter at Gati, whose insights on logistics, supply chain sector, etc. Will shed light, but I think Dhruv is far beyond that, moved beyond the Gati story, and therefore we hear many more perspectives from Dhruv beyond that. We have with us Shrishti Sahu. Shrishti is the managing partner at SSV Family Office and brings a unique perspective on how family office strategically approach the whole risk and high growth investment decisions. We have with us also Vineet Agarwal, managing director at TCI, an accomplished leader with invaluable experience in scaling and navigating complex markets here. And moderating this panel here is the wonderful and really experienced Syna Dehnugara. Syna leads private markets expansion for family offices at Trica and has many years of experience of engaging at such panels before. So over to you, Syna. Please take it away. Folks, I request you to kindly take seats, and we will have the tea break post this session since some of these speakers had to leave. Please request you to kindly take seats.
All right. Thank you very much for all of you to be here and listen into this. I think, while we did have the formal introduction, I think what will be good as a way to really introduce yourselves to the audience here is maybe spend 2 minutes to tell us why as a group or as individuals or as families, you all have decided to look at startup investing in particular, right? So a minute or two just to give us a sense of what your original businesses or line of interest was and why startups figure in that. You want to start, Dhruv? Yeah.
Hi. I think I got very excited about startups because back in the US when I was studying there, so my batch or my batch was probably, we were the first users of Facebook, YouTube, Twitter, which was very exciting. And then we also saw the progression of companies like Google and Amazon. And when that whole startup culture came to India, then it was very exciting to be part of that or to be involved in that in some way. And that's what stoked the interest to look at startups or try and work with them or invest in them.
All right. Shrishti, for you?
Thanks, Syna, for the question. So for us as a business group, our businesses were across very traditional sectors such as automotive, hospitality, real estate, financial services. And we knew that there was a tech disruption coming, having seen different markets evolve over a period of time. If you look at what happened in the US and UK, and it was a given that it was going to happen to India also. So we set it up as a way to participate in India's growth story on the private side and also find strategic place for ourselves. And we started 9 years ago before family offices were a fancy term which was accepted. But it's been a fantastic learning journey for us.
All right. Vineet, for you, large listed company, generations in the business, what drew you towards looking at startups?
I think that's exactly the reason. Generations in the business is what prompted us to look at what was happening outside the business. Because there were a lot of changes happening in the logistics and supply chain industry. And we were not really getting to know what's happening. To just get into the deal flow, to understand the markets, to understand the ecosystem, the only way was to get into it by putting in not just a thought, but also capital.
All right. So now that we know the why, right, of looking at startup investing, I think let's just understand from each of your perspectives. And I firmly believe this, right, working with, over 100 odd family offices, right, that it's really different strokes for different folks, right? The motivation to get into it also differs. And then how you go about making those investments also is materially different, right? So maybe again, starting with Dhruv, if you want to give us a little bit and the audience an insight into how you looked at asset allocation, right? When you look at your overall AUM, how do you decide how much of it you're going to allocate towards these new age companies? And then once you decide that and you iterate on it for some time, how do you think about direct, indirect investments and so on? What's the framework that you all have developed?
I mean, I think we kept it very simple. So the family office outlook and philosophy is capital conservation first and maybe sustainable growth. So something that is heavily marketed or very exotic is something that typically we don't get into.
And that is across the board, whether it's public or private.
Public or private.
Okay.
And what we came up with was a simple formula that we'll do 10% or less in AIFs, startups or other AIFs, 50% in public markets, and 40% is kept, is liquid. And the 40%, the idea is that if there are opportunities that are very compelling, could be in the private sector, and today we are finding a lot of great companies, SMEs across sectors that need capital, systems, process, people that can grow. So this is a new iteration that we've brought about in our family office. And we did the first acquisition, which is in the supply chain space, which is my, where I've spent all my time. So so it's just been about a year. So I pray every day that it's not going to be an expensive mistake, and it's not going to be an expensive lesson.
Yeah.
But
and over
we've
there, you
started on
hope
that.
to work with that company closely?
We are working on that company. So the promoters, the existing promoter continues as the CEO of that business. We are funding it, and I work with him pretty much full time on that company now.
All right, interesting. So 10% to privates is what you said, right? What about you, Shrishti?
I think the way for us, how it started was 9 years ago when we started. It was more about figuring out which are the funds that we can potentially back. Because as a family office, when you're starting out, you also have to be very mindful that you might not have great access to the best quality deal flow. And that is an inherent risk that you're taking on the private side if you do not have access to the right deal flow and the top founders who are going to build in this space. So we started out by backing funds, and gradually over a period of time, as we got more comfortable with the space and we started seeing some follow-ons happen, some valuation markups happen, we started increasing our direct investments. So the framework that we follow is that, when we're investing in funds, we are looking at funds as a way to diversify and also capital preservation in one sense. And when we're doing direct investing, that is for strategic plays. So that is a bet for us in terms of wealth creation. How do we look at it from a growth perspective? Is this a potential M&A opportunity or not? Are there strategic synergies or not? And in the direct investments, operators from our family business tend to be more heavily involved. So that is a framework that works well for us.
All right. For you, Vineet?
So for us, it started quite differently. And since the objective was to understand what was happening in the logistics and supply chain space, what we did was we went to the board and we said, look, to be ready for the future, we need to know what's the future. And hence, we need to invest capital into that. And let's see the deal flow. So we created an entity called TCI Ventures that started looking at these investments, some directly, but actually the focus was entirely one theme, which was logistics and supply chain management. And we made many investments from there, including partnering with another firm, Carrot Capital, to actually create a more focused logistics and supply chain fund as well. That has evolved, of course, in the last decade or so. That continues in the company, but beyond that, the family office has started to do other things as well. And obviously, the family office does not do logistics and supply chain, because then it would be a conflict of interest. And the family office is looking at about 10 to 15% of its of the wealth to be managed under the startup ecosystem. Now, I would say it's a relatively, I do not think we have a capital preservation policy that much, because it is only 10-15% where we want to be aggressive. So we are, it's also not a spray and pray kind of a attitude, but it is also diversified, extremely diversified from hotels to financial services to different areas and sectors. But that's the intent from a holistic perspective. Keep the focus on logistics supply chain from the company, and from a family office perspective, look at a more diversified portfolio.
Got it. And just to double tap on that point, and you can start with this, Vineet, yourself. Is you brought up the point of when you're doing startup investments, it's not so much from a point of view of preservation. You're okay with taking that risk in an already very risky asset class, right? And therefore, is it that lens of alpha generation, right? And what does that alpha generation really mean? Because we see for a lot of investors who are setting up their family offices or investment vehicles and want to do directs, they've been sold this story, coming to a point you made earlier, Dhruv, that this is where you're going to generate that alpha, right? And then everyone's chasing that alpha. How do you all look at it?
It is, it's a balance that we look at also simultaneously. We are looking at aggressive returns, but we are also looking at putting money into funds where we know there are people who are doing the due diligence simultaneously versus as well as the direct investment. So it's a combination of both. And I think the alpha comes from both as well, in the sense that we know that out of the 10 investments we'll make directly, maybe 2 might do really well. Otherwise, most of them will not. And on the fund side, I would say mostly everyone would preserve capital to a great extent, and some of it will deliver a mega alpha. So I think that combination has helped us. But maybe we'll talk about it later. But the most important thing is to actually learn from the mistakes. So the failures that we've had is really the ones that we look at very closely to see that how can we do better.
No, let's talk about it now. Like, always nice to hear about like material things, right? Rather than talking theory. So talk to us about maybe one of your failures and what you learned from it.
Okay, so I mean, I can talk about it here. One of them, and
on a no-name basis. Let's do it.
I can even name names.
Okay, all right then.
Actually, this happened not on the family office, but in the company side, which is, I just want to think about, we are a listed company, what else, what can I say and not say? Okay, one of the companies that we invested into from the, and on a no-names basis actually, better, and you don't want SEBI to be running after you, is a logistics delivery company famous for starting quick commerce in India.
All right.
We all know.
I think we can guess that.
Yes. So again, the learning, we doubled down on that company because at one point in time it was doing really well, really well, and it was the blue-eyed boy of the country, and we felt that it should do, and bankers came to us and they said, this is a great opportunity, why don't you double down? And because we thought we understood that business, being in logistics and supply chain, we were blindsided.
Got it.
And also, clearly, it is not just the business. It is the founders. It is the other larger investors. It is the overall ecosystem. All of those things have to be always, you have to always keep a tab on it. And unfortunately, we could not. And that's where we lost the entire investment.
All right. Dhruv, you look like you want to make a point to that.
Similar,
Go ahead.
Similar experience of thinking that we understood the sector, understood the business model, went direct, but they didn't do so well. And so these were 2 investments. And so therefore the learning was that we are not as smart as we think we are. At least I'm talking about my family office, I'm talking about me. And so the learning from that was that, look, we'd rather invest in a fund that does this day in and day out. And in the startup ecosystem, like there is a system in the ecosystem, right? System in the ecosystem. So you have good founders that go to certain funds. And to what Shrishti was saying earlier, like how do you attract deal flow? So the best funds, fund managers attract that top tier deal flow or the best founders. Once they get checks from those initial funds, then you have the Series A, Series B, right? Build them up so that they can burn through $100 million a year, and then you have SoftBank
Can be
and
in a day
Tiger.
also now.
or in
I
a
think
day,
we are getting to that
then
soon.
you know that Tiger, SoftBank, all of them will line up. So there's a system in the ecosystem, is what we realized, and we realized that okay, going through a fund just makes sense because it's kind of protecting the downside while having an opportunity at getting that alpha.
Yeah, especially maybe if you have co-investment rights and you're able to get some of that with some of your VC fund managers or private equity fund managers, then you also have that kicker, right? Or being able to double down individually in some of those outlier companies. But Shrishti, I mean, since we've gone down this rabbit hole, right? Your own experience in terms of backing fund managers, and we were talking about this earlier, right? So looping it back to the point of alpha, what public markets generate in a cycle, VC cycle, and what private markets have been able to deliver, right? Do you look at, a 7-8 year cycle and say, okay, VC is not even touching what public markets have delivered? And then how do you go back to your family and someone, because you're managing at least this part of the asset allocation completely, right? Apart from overlooking all the other investments, how do you go back to the board or to your family council and still ask for more capital to deploy into privates?
Yeah, I think that's an interesting question, but because we started investing in funds first, I think the realization there was also that ultimately the funds, because of their shorter fund cycles, will always give sort of muted returns. So we actually are not looking for alpha generation in terms of funds. What our realization was, and even if you look at the case of Naukri and how they generated returns, they actually stayed invested in Policy Bazaar, Zomato for 12 to 15 years. So if you think about it, the India fund cycles are actually not in favor of compounding or long-term wealth generation or alpha generation. So for that reason alone is why we are doing more direct investments. And that's a completely justified use case as well, because you can totally see that while the risks are higher in going direct, the returns will always be a little more muted when you look at it from a fund perspective. So it's a little contrarian, but it comes from learnings across market cycles. But you have to diversify across funds and direct investing. At least that's been our personal experience. Maybe direct investments might be 30% of your portfolio and fund is 70%, but you kind of need that diversification to be able to create alpha on the direct side.
All right. Since we are talking about funds, allocating to funds, right? I think we perhaps talk a lot about what we look for in founders and what we look for in companies, right? And we'll come to that in a bit. But when you all are evaluating fund managers, right, with whom you want to deploy capital, what do you look for in them? Or, how do you, again over there, right, I think in the morning, Mr. Bhichandani made the point that there are close to 1,000 odd funds just in the venture space, right, across the large ones and all the micro VCs. Then you have, platforms that are creating, micro syndication and so on and so forth behind angel investors. How do you weed through all that? Any frameworks that you might have developed? Again, learnings purely on a no-name basis, perhaps, from, experiments that didn't work out. Any of you can go first.
Sure. I think in selecting a fund or fund managers, one thing that we tried to do was go in their second fund or not their first, especially if they're first time fund managers or what have you. The other thing that was really important for us was to go through reference. Somebody that had already invested in fund 1 or fund 2, fund 3, what have you, what has been the experience with the fund manager, what kind of deal flow have they seen. So that was how we evaluated, and that's how we went in to the funds that we're invested in now. In the startup space, the other way that we looked at it, we're invested in a fund today that's out of Israel that only does deep tech companies. And while that's their first fund, it was a very compelling investment to make because they came from the startup ecosystem. They had themselves successfully listed a couple of ventures between the founders of that fund. And they're the only ones that had sort of insight into the pre-seed and seed stage. I'm not being very articulate about it, but yeah, for us it was primarily if it's fund one, I mean beyond the first fund and with reference.
It's also interesting, right? Because you're going to the heart of where maybe deep tech research takes place outside of the valley, right? Is a market like Israel. Right, where you can actually deploy capital.
I mean, and then, you know, they also have where they have to serve in the military. So a lot of them were actually deploying tech in the real world, coming out with an understanding of what works and doesn't work, and then starting their venture. So that was the compelling reason to sort of go in, even though it was a first-time fund manager.
Right. Shrishti, for you, you've invested over a couple of cycles perhaps in...
Yes. So for us, I think exactly the same. We tend not to back first-time fund managers, and I think that's true for most family offices that I interact with as well. One thing that, you know, when you're looking at founders, you're also evaluating what is their competitive advantage. I think that's the same question we're trying to answer when we're looking at fund opportunities. If you see just over the last 2-3 years, there's this whole new crop of new GPs who might have operator backgrounds and have built phenomenal businesses, now raising funds. But you need to figure out what their competitive advantage is, right? Like if it's a fintech-focused fund, do they have all the industry relationships in space to be able to go and help a company actually go navigate those first 2 to 5 years of their journey when it's a lot of variables are at play, right? So we are actually trying to answer the question for ourselves, what is this fund manager's competitive advantage? And you can track that in different ways, I would say.
Yeah, and what's your decision-making timeline, Shrishti? I mean, I just wanted to make it clear, right? I mean, founders feel that, you know, they are raising forever, and it takes them, you know, anywhere between 3 to 9 months to close rounds, at least in this market, right? It's been like that for the last 2 years. How long does it take you to decide that, okay, after your diligence process, that you're going to back a fund manager?
Well, it really depends on the fund manager as well, right? Because some fund managers tend to have a pull where within 2 weeks of launching the fund, they can actually wrap up the entire fund, versus some fund managers who might be out in the market for 18 to 24 months even. So one is also a little dependent on that in terms of
is that a
what
red
is
flag
the pull.
for you when it takes long for a fund to fill out?
Yes, in a way, because, you know, if as a fund manager, your role is to be able to attract capital. And if it's taking longer than expected, then there is something missing in the fund's DNA, which is why that is happening. It could be a market cycle also, but people understand that, right? But for usually if it's taking this long, then, you know, it's a red flag.
And typically your process would be 3 to 6 months?
We try to do it 8 to 12 weeks, yes.
8 to 12 weeks.
2 to 3 months, yeah.
Okay. Vineet?
Oh, I don't want to repeat. I think it's quite similar in terms of our understanding. But what I would recommend to do is, as the community, is to actually build a compendium of all the funds that are coming in. And, you know, I think we see all these mutual fund ratings systems that come out, and maybe something like that could be done for all the funds that are coming out.
Yeah, in fact, in the latest like SEBI consultation paper, this came out in November, right? There is actually a provision there to create a benchmark or benchmarking, much on the lines of what CRISIL and others do for all AIFs, right? Cat 1, Cat 2, Cat 3. As you know, someone who manages a few funds, looks daunting, but we also recognize that it's a need of the hour, right? Especially for first-time entrants into private markets. It's very, very important that we have that, right? And I think we've been around long enough, right, to do that service to ourselves, I think. All right. You know, just in terms of expectations from the startup asset class, right? I think when founders go to VCs for fundraise, the expectation is to grow fast, burn through, let's just say, X million dollars of capital and achieve growth, which most likely is not profitable, right? Until you get to a steady state of some sort, right? And that is actually what the VC model is globally, right? To be able to help founders grow quickly, companies grow quickly. When you look at it from your lens as a family office, and we read about this a lot, right? That we are patient, our capital is patient, and you know, we will back you in the cycle and outside the cycle, right? Do you think that is true for what we are seeing in India and how things are panning out? Do you think family office capital that's coming into the market is patient, or is it simply trying to emulate the VC?
I think anyone who is trying to do that is going to have a really hard time, because what usually ends up happening in India, and I think this is true across the world, greed and fear operate our markets, right? So typically, LPs don't even want to see 1 year of underperformance. And, and which is not realistic, but that's the aspiration that most family offices have. And that is not a realistic expectation to have from the markets. So I think it goes back to the fundamentals of investing. So when you're looking at even Indian equities is only 3.5% of the world equities, right? So you have to think about it from a sector stage lens. Where do you want to be allocated? Because most of it, actually, the decision in terms of wealth creation actually lies in 80% asset allocation and not security selection. And that's where I think people get very carried away. They focus too much on selecting the right company instead of focusing on which assets to back. And with underperformance, even 1 year, I think that is what really backfires for a lot of these LPs, which I've had conversations with. Family offices are just not used to dealing with these kind of losses, or even have the ability to be able to see through some of these market cycles, because they don't understand the DNA of burning through hundreds of millions of dollars without having anything to show for it. So, you know, I think family offices, even though they want to be long-term patient capital, but I think we are still in very early stages of Indian family office capital deployment cycle, and it should grow 10, 15 years later, because there'll be more learnings in the ecosystem.
All right. Dhruv?
Yeah, I think, like Shrishti made the point that, I mean, in my experience, family office capital, number one thing that a family office fulfills for a startup is they fill up their cap table. I mean, fill up the round, right? Especially in the later rounds where the VCs are not able to complete the round. So, and of course, they bring in the expertise, etc. But in terms of the return expectation, I completely agree with Shrishti that I think rarely have I seen a family office that says, look, we are going to be long-term and patient, especially on the startup market, and not start panicking when there is a down cycle and try and shift things around.
All right. Vineet, for you?
Yeah, so, you know, I think what family offices tend to do is think about them as an extension of their business. And when you run your own business, you know, there's I think a Gujarati saying or something that if your business is not profitable in 1,000 days, shut it down. So that's when we start new ventures in our company or business, we say give it 1,000 days. If you're not able to make a profit, we shut it down. Now, obviously, this mindset will not work for a startup. But the mindset that does work is to give yourself that time that, look, it's going to be the founder saying 2 years, 3 years, we'll invest into that time. They're burning through that, that's fine. We'll mentor them, we'll see how to channel that. If it doesn't happen, then you write it off. Some people might have the conviction to put in more money and have that patient capital. But I would say that that maturity is still slowly coming into the Indian markets, Indian family offices.
All right. Would you say that typically the sectors that the VCs have gone after, right, and invested in, also are kind of divergent maybe from, you know, some of the sectors that y'all might look at to back, right, with maybe a longer length of capital, you know, allocation cycle, or that perhaps you feel that domestic VCs have not done enough, maybe in the deep tech or core manufacturing or defense or healthcare space, right? And you see niches for not just your families, but I'm trying to expand it to more general, where this type of capital can come in, which has a very different lens on how businesses in these segments also grow. Do you think that that's a gap that family office capital can fill, rather than simply chasing, you know, the very, very high growth sectors?
I think, yeah, on that, I mean, I think the VC family office in India has become very good at investing in sectors like, e-commerce, health tech, ed tech, fintech, SaaS.
That's what the VCs are doing, right?
And so when you say deep tech, I think the deep tech sector in India is still very, very nascent. The space sector is something that has really picked up over the last couple of years. Most of the startups that started, around 2021, 2022, very happy to see a lot of them are getting, their satellites are being launched into space, their tech is actually getting tested. But other than the space sector, I think still very, very nascent in other deep tech, but critical spaces like, say, semiconductor, right? And semiconductor is an area, for example, that needs extremely patient capital, maybe over 20 or 30 years. And that's probably not an area that a family office or a VC will be able to fulfill. That's probably going to have to be government funded, at least to get that sector going.
Yeah. Shrishti, your point of view?
I personally feel that the first vintage of funds actually focused too much on copy pasting the Valley model, right? And that's why we've seen so many mortalities in the consumer tech sector. And majority of the funds which have written off are also in the consumer tech sector. Because, what's India's hope of producing a company like Meta when we don't really allow or accept failure and experimentation? And, like Mark Zuckerberg can one day decide that I'm putting $100 billion in metaverse and next day not do it, right? But we don't give our founders that kind of freedom and flexibility to be able to explore that. And yet we expect outcomes which are mirroring the Valley outcomes, which I find is a little ridiculous, to be honest. And that's where the fund managers have really learned from those experiences. And consumer tech in today's day and age is really struggling. And the companies in different portfolios are not able to raise follow-on funding because I think LPs have also conveyed it to fund managers that, you cannot chase the Valley kind of outcomes in India because the DNA is so diverse, right, in terms of India. What we see as potential opportunities, like definitely in terms of manufacturing, defense, these kind of plays are going to be huge. And manufacturing is actually a very core theme for us in terms of investing.
But over here, would you like to be more direct in those opportunities given your own background, or would you like to have fund managers focus on it?
I think, again, what I said before,
both.
we are doing a mix of both direct and funds.
Yeah. From your perspective, Vineet, and let's talk a little bit about sustainability and so on as well, right? These are all areas where we've not seen too many great funds get created, right, in the impact investing space. Maybe we have, maybe one or two notable exceptions, right? Do you believe that those are certain sectors where domestic capital allocators can really take charge and deploy capital, build expertise, for the next 7-8 years?
Certainly, I think that is a case in point. I think related to climate change, sustainability, there is a big gap in the Indian ecosystem. We've seen when I visited the Valley last few years that I've been going there, we've met a lot of funds that are very focused on climate. And it's not climate from an EV perspective, okay, we are investing into an EV company. No, but it's more into, let's say, how do we get a battery to be recycled up to 98%, a lithium ion battery. So that kind of technology or that kind of ultimately investing is not here yet to that extent. There are very few, as you rightly said, some funds that are doing that. So yes, I think it will be a combination of some of the funds that will look into such thematic areas, deep thematic areas which have a long gestation period as well as, but some of them have a very high impact. I think you have to see both from the gestation period, which could be things like semiconductors or defense or manufacturing, but some have to have immediate and urgent impact, which is sustainability and climate change related, or even on the social side, because of the disparity that exists in our country.
Correct.
So some, or mental health issues, for example. I mean, I'm talking about broadly speaking, but health or social inequality and climate change are immediate and urgent needs. For them, for those areas, we need specific capital that will go in, and that will come from funds or from individuals who are very passionate about the subject.
All right. Okay. To wind this down, just want to let anyone know if they want to ask a question, you can raise your hand and we'll have the mic around. But, you know, as we, at the beginning of the year, anything notable that you have planned for your capital deployment in 2025 that you want to share with the audience?
Climate change.
Climate change?
Yeah.
All right. Shrishti,
Manufacturing for us.
Manufacturing for you. Dhruv?
I think it will be on the supply chain side.
All right.
Supply chain.
Okay. Very, very interesting. Anyone? Any questions? No, I think we are good, and I think we had a very good, interesting conversation, which will have, you know, wider reach online, perhaps. Right? Thank you. Thank you very much for joining us today.
Thank you so much.
Thank you very much. Thank you, Syna, for this wonderful moderation, and thank you for your time. We should be seeing more of you here at TIE. Thank you for being with us for the first time. Thank you, folks. Folks, we break for a brief tea break. We won't break for a very long time, just a 20-minute break, and request you to kindly be here back in time for the rest of the sessions. Thank you, Dhruv, Shrishti, Vineet. Thanks a lot. Thank you.